Well, welcome back to another segment of Arizona Mortgage News Insider Update. We have our insider here, local resident expert Mike Goblet of United Mortgage and Financial Group. Good morning, Mike. How's it going?
Good morning, Matt. It's good to see you again, and it's going great, thank you.
Well, thank you. Yes, so today you're going to talk about some funky acronyms, LTV and PMI. Can you tell us what those are all about?
Yeah, these are important terms to know and understand their relevance in the mortgage process. LTV is loan to value, and PMI stands for private mortgage insurance, okay? So let's start with loan to value as the first, or you're really going to hear it in the process simply said as LTV. And it's actually, LTV is one of the key elements in determining a mortgage and what the rate will be. And what LTV stands for is the percent of ratio of money you are borrowing versus the value of that home. So what the lender sees is the higher the loan to value, the higher the risk. Risk being interpreted as, for instance, if you don't borrow any money, you have 100% loan. Your risk of defaulting on that loan, if something goes wrong in the future, is greater than if, for instance, your loan to value is 50%. So they price that in as an element of risk. Now, that's also tied to other variables like your credit score, which will affect it as well. But loan to value is one of the key elements in determining a mortgage.
And are there some ratios that you need to be aware of or you need to hit to be in the ballpark?
Yeah, there really are. And a lender, usually the maximum a lender wants to go to is 80%, or if you're buying a home, it's putting 20% down, okay? This is as high as they really want to go. Now, that doesn't mean you can't go put less down and have a higher LTV. I'll get to there in a moment, but at 20% or less than 20% equity, that's where the other acronym kicks in, PMI, private mortgage insurance. Okay, if you have less than 20% equity in the home, the lender will require of one sort or other PMI or mortgage insurance. Now, what that is another third party that comes in and protects the lender on that portion of the loan greater than the 20% equity. So let's say you only put down 10%. This other lender comes in and says, I'll tell you what, I will cover that portion between 20% and the 10% down and protect you from default. Now, bottom line, it's not you, it's the bank lending you the money they're protecting. And that's why you pay private mortgage insurance. You're paying for the privilege of that lender to come in and protect the bank against your default above that 20%.
And I would imagine that insurance is relatively high, because I hear people talking all the time about getting to that 80-20 so that they don't have to pay insurance.
Right, and it's determined by a number of factors. There are different breaks in terms of the costs, meaning like if you put 15% down or 10% down, actually you can put as little as 3% down on a conventional and 3.5% on an FHA, but obviously the private mortgage insurance gets higher. So now there is another option which you should really ask about if you need MI or PMI, and that is what's called lender paid MI. And now it's a little bit of a shell game, but bottom line, it can save you money on a monthly basis by having the lender cover that difference themselves with the lender paid MI. Now, you end up with a slightly higher rate for the life of the loan, but it can save you thousands of dollars on a monthly basis for the first X number of years till you might be able to get out of MI.
Very cool.
So learn both those terms. and understand your options. They aren't cut and dried. And bottom line, too many lenders won't explain the options you have. They'll only tell you what they're trying to sell you.
So, Mike, do you know someone that would be willing to explain those options to someone in more detail?
I do. No, actually, I only know of myself that would be willing to do that. No, there are obviously other good mortgage brokers, but I am happy to explain at no charge or obligation what the options are on any of the cases, or just to provide the knowledge for people to go forward.
And what would be the best way to reach out to you, Mike?
Well, you can call me at the office at United Mortgage Financial Group. Our number is 480-503-3533, or you can call me directly on my cell at 480-220-2329, or email me at mike.goblet at our company initials umfginc.com.
Fantastic. Well, thanks for enlightening us with the acronyms. I'm glad you didn't cover things like LOL and BFF. So these are ones we actually care about.
These fall in the category of OMG. So.
All right. Well, always a pleasure, Mike. We'll look forward to your next segment.
I look forward to providing as well. We may even deal with another acronym, DTI.
DTI. Okay. Looking forward to it.
Okay, Matt. Take care.
Bye-bye.